Most people know their credit score matters when buying a home, but what most people don't know is exactly how much it'll cost them. We're not talking about points. We're talking about real dollars, real money in your pocket, thousands of dollars over the life of the mortgage. My name is Kelham Brown. I'm the mortgage official. This is the UM Show, joined today by Dave Brown. And today, pulling the real numbers on your credit score and what actually costs you the most money.
You know, Kel, here's one of the things. I think this is one of the most understood topics that we could talk about. And so I'm glad we're going to do this because there's three things that I see people do incorrectly all the time. One, they either don't check their credit because they're afraid that it's horrible or bad, or it's too low and that they wouldn't be able to buy a home. They assume that it's good or that it's acceptable, or the third thing, Kel, and this is probably the most widely, it's so easy to pull credit reports online with, Credit Karma and things like that. And we'll get into that during the show. But those credit scores that you see online are not the same scores that we use as a mortgage lender. And so it's really important to understand. And so those three things really kind of compound and add up to three mistakes that home buyers can make. So when they're trying to buy a house. So let's dive in and talk about, I'm going to hit you with the first question, and that is I did some research, the number one most widely searched question about credit online is, what credit score do I need to buy a home?
See, now that right there is a misconception already, because there isn't a magic number that if you build it up into X point that you're guaranteed to get a mortgage. Secondarily, different loan programs have different starting points. So like FHA loans, they go down to a 580 with the minimum required 3.5% down that we've talked about on the program. But you could even go down as low as 500 if you could produce 10% down. And so just because you have a 500 score, the requirements change even on the same program. So a couple other ones like conventional typically start around 620. Again, not a guarantee for financing. VA loans don't have an official minimum. Same thing with FHA. Different requirements allow you to get financing. So you could have 500s. Obviously much easier the higher up you go, but we typically see lenders on VA loans stick pretty close like FHA, 580, 620, and then USDA for your agricultural rural areas are really 640. So, but the key point I want people to take away is just because your Credit Karma or your credit card app says you're at a 640, 660, 680, still doesn't mean that you're going to qualify for the same rate. And you're definitely not going to be getting the best advertised rate you may see online.
That's great information, Kellen. I think that the key is, and you and I were talking offline, and I use the analogy, it's like making a sandwich, right? I like to put some extra layers on my sandwich. And so when you do that, that's the thing about the credit. Even though you may have a credit score, as you were saying, that falls into that bucket where it says that's the minimum that you can have, there's other layers that they're looking at as to what's in that credit score. It's not just the number, there's other things underneath that. And so we'll cover some additional things here. All right, I have another question for you. Let's keep this moving, Kel. So let's put some real numbers on this, because our listeners, maybe they think that, hey, if your credit score is like 100 points different, that's where, you'll see a difference in like approvability or interest rates. But let's talk about even something that people can really understand. Let's talk about a 720 credit score versus a 680 credit score. And does that 40-point difference, does that have an impact upon interest rates, monthly payments, and what people would spend over the life of their loan?
100%. So in credit rating, they go in increments of 20. So 680 to 699, 700 to 719, up and down that scale. And so let's just say someone has a $350,000 house and they're putting down 5%. Somebody in that 680 bucket, their rate could be in the 7.375 And then at a 720, you might be just under 7. Now that's still a difference of like $166 a month. That's $2,000 a year. And I think when we ran the math over 7 years, that's $14,000. So not only does that affect your interest paid, your monthly payment, it also affects your mortgage insurance, because with higher credit scores, you get lower mortgage insurance premiums, and increasing that score allows you to bring that number down as well. So it's not just a interest rate question. It's a all encompassing question where you're saving dollars upfront and over the life.
That's interesting. And so, you know what? I don't think most home buyers or potential home buyers even were aware of that your credit score impacts your mortgage insurance. And to take that a step further, Kelham, I'm going to add on one additional layer to that. When you go to get home insurance, it's just like when you're getting auto insurance, they look at your credit scores. Now, it's a different credit report than what we look at, but the same thing when you get home insurance, they're evaluating your credit. And so not only is the mortgage insurance a little more costly with a lower score, but potentially even when you go to get home insurance on your property, that could drive up that payment. So again, this is far reaching when we start talking about credit scores. This is good information. Can we keep going? I got a couple more questions for you here.
Go ahead and shoot.
All right. So let's talk about what actually moves your credit score the fastest. And let me kind of phrase what I'm talking about here. Somebody's thinking about buying a house in the next, let's say, 6 months or a year. What are the factors that are going to help improve or move their credit score the absolute fastest, especially if they're thinking about buying, let's say, in the next 3 to 6 months? What's going to move the needle to get the scores up quicker?
Perfect. The biggest lever people have the ability to move on their own is credit card utilization. We've all probably heard the rule of thumb of keeping your credit card usage at 30% of your credit limit. So a quick example is if you have $1,000 credit card limit, keeping it at $300 or less at the time of your billing cycle. So if you're able to get those cards under that, that's going to have the largest effect in the shortest amount of time. So studies actually show roughly 1 in 4 credit reports have mistakes. That would be the next item that people would be able to go and evaluate and see if there are errors made, and that could increase their scores by 20 to 40 points. But we coach people in our consultations and our slam dunk game plans. The credit card utilization is the number one thing that you have control over that can boost your scores in the shortest amount of time.
Yeah, that's great information, Kel, because the reason they have control over that is they can pay that down potentially if they have some additional funds. They can borrow money. They can do all kinds of things. But by paying that down, it literally within one credit cycle of reporting will show improvement. Now, here's something interesting, Kelham. I was just talking to one of our good friends the other day at one of the credit repair companies that we use that are very reputable. And she was actually telling me that she's found that the number, even though it says they're under 30%, she's finding maximum scoring with her clients that she's helping improve their credit is around 10%. So think about that. If you have $1,000 credit limit or a $10,000 credit limit, keeping that under 10% usage is maybe the sweet spot. So it maybe is even less than kind of what you would see published online. So I think that's really interesting. And so I think that's a big factor. The other thing is, like you said, getting things off your credit report that are incorrect. If there's something there that's incorrect, that's something over a 60 to 90 day period of time you can get done and get those things removed if they're erroneous on your report. So I think that's really important. Good stuff here.
One more point in there.
Yeah, go ahead.
Because I think the question we get all the time is, well, what should I do if I have multiple cards? Should I get them all down to, let's just use the 30%? Should I get them all to 30, or should I pay them all the way off and move on to the next card? And there's no right or wrong, but I think For us, we would say get it all the way down, because then you're removing the monthly payment and you can start snowballing that into your next card. So you'll pay it down even faster. And then we'd say cut up the card that's paid off. Don't use it again.
Yeah. Yeah. And here's something though. Again, we're just talking to give good information here. If you were to ask me, hey, Dave, Kelham, should we keep $100 balance on that card or pay it off to zero? The answer is leave $100 on there. Okay. Because again, just the way the credit bureaus score things, they want to see that there's a monthly payment being made. So you could actually harm yourself if you paid that off in full. Now, what you just said, Kel, about cutting up the card, I think that's a great idea, especially if you're having trouble, not using your cards. Cut that thing up. But I always tell people when we're doing our slam dunk game plan, keep the card open, keep a small balance on it. Don't pay it off in full. We don't want to pay too many cards off at once. You want to do that slowly. And even once you've paid cards off, you want to continue to use them month over month. Maybe put a tank of gas on your credit card. The next month, maybe you put some groceries on it. Something that you can, even if you're paying that off monthly, but it's just these little tricks of maximizing your points are very important. Now, that leads into another question, and you started to touch on that. So let's talk about, if buyers have some additional funds. We get this question all the time. We have an extra $10,000 or $15,000. We could either put that into the home because we'd like to buy down, the mortgage as low as possible to get the lowest payment. Would you recommend, or is there a preference, or is there a rule of thumb whether somebody, if they had some additional funds, should put it down into the mortgage or pay off credit card debts or pay down their debts? Where do you fall on that?
This one's a little tricky. And so every case is different. There are some people who have a lower credit score that may be approved if they have a higher down payment on their loan. Now, on the other hand, like you said, a buyer has $10,000 to $15,000. That's if they put $10,000 down more on their mortgage, it's about $60 in payment. Whereas if they took that and paid off a $10,000 credit card, that's $300 or $400 a month in minimum payments. You're freeing up $340 a month in cash flow that if you really wanted to, you could put that back towards your mortgage and pay it off faster. So there's no right or wrong, but it's the best use of funds for what you're trying to accomplish. Sometimes you need it to get approved for the loan and you need it as the down payment. Other times you can use that to free up cash flow, either snowball other debts, retirement savings, 401ks, S&P 500 accounts, a bunch of things that we kind of talk about to reallocate funds. But there's no right or wrong. It's really, what is your plan? What do you need to be approved? And then what can we do with the excess?
I love it. Man, that was good information right there. And what I heard, one size again doesn't fit all. And this is why you need to really prepare and understand what's right for you. Just be, everybody's watching, videos online. I was scrolling Instagram earlier this morning before we recorded this show. And you can just get caught up in watching other people's advice, OPA, other people's advice. But that may not be best for you. So let's roll into the next one because it ties into there. So somebody's they're sitting here listening to this and they're thinking about buying a house. And I just saw a statistic that over 30% of people that are renting, okay, listen to this, over 30% of people that are renting plan to buy in the next, or would like to buy in the next 12 to 24 months. Okay. So for the people that are thinking about buying a home in the next 12 to 24 months, what would you recommend? When should they start thinking about kind of their credit and getting things in line, sitting down with someone like us so that they understand and can get a game plan put together? Is there a time frame that you recommend?
Absolutely. Ideally 12 months. And kind of to your prior question, how early should they start talking about it or thinking about it? you put me on an authorized credit card as soon as you could to start building my length of time and accounts. That's another layer that we'll talk about in consultations is length of time open, but as soon as you can. So somebody looking 12 months out, even 6 months can work, but a year gives you room to fix things like your late payments. If you have collections, high credit card balances, the credit history I just mentioned. 12 months gives you strength that you've been good through the current 12 months. It also gives you time to negate some of the bad things that may be on your report. So the mistake people make is they wait up until 30 or 60 days and think they can fix their credit and make it perfect or better in a short time frame. There's only so much you can do in a 30-day window.
Makes total sense. Question that I have for you now is, what is a rapid rescore? People that are searching online might see that term. So what is a rapid rescore and how does it work? Can you kind of bring that one together?
For sure. It's a tool that we use to help people up their scores in a short amount of time. Now, I know what I just said. Normally in 30 to 60 days, you're not fixing your credit by 100 points. But a rapid rescore allows your lender to update your credit report quickly, normally taking about 30 to 60 days. So with that rapid rescore, we can update your scores within 3 to 5. So it's often used when someone is paying down a balance, like a high credit card, paying off an auto or personal loan, or correcting errors. So somebody who may be at like a 695 and needs to get to a 700 tier to achieve their goals, that's where we would use that, or trying to get somebody from a 560 to a 580 so that they can put minimum down. So that in the short term, we can get that accomplished and not have them wait another 6 to 12 months until a new credit report either gets updated. We can do that with a rapid rescore.
I love it, man. That is pretty darn cool. That's good information. I like it. Okay.
Dave, it's time for the 2-minute drill.
Oh, okay. Let's go. Let's roll.
Oh, last 2 minutes of the episode. So question for you. So your credit score is costing you money, but how is someone going to keep track? I know we mentioned some of the apps. How do we keep people conscious of their credit, of the couple things that we mentioned, and get a real mortgage review?
Yeah. That's a great question. And so there's a couple of ways to do it. And at the beginning of the show, we talked about for those that are looking at your credit online, let's say using Credit Karma, they're using, and I'm not going to get into the weeds as far as the different scoring models. If you're watching this, you can go watch or look this up. There's different scoring models. Let's start with that. I'm not going to explain the exact model numbers, what they're called, just because it gets confusing. But what you need to understand is if you're watching your score, let's say with a credit card, you have a Cap One card, or you have a bank card, right? That particular credit score is not what a mortgage lender will use. We use what's called a tri-merge credit report. So we're taking all three credit scores and we're merging them together. We're throwing out the high, the low, we're using the middle score. When you're seeing your scores online, it's a different scoring model and they're not letting you see all three. In the lending world, we're moving to a new scoring model, but we're still using an older model. Now, the reason I tell you all that is one of the things, as Kel said, if you're thinking about buying a home 12 months out, it's not a bad idea. We need to look at your credit, okay? If you don't know what it is. Now, here's the thing. If you're seeing online that your scores are 800, then we know you're going to be okay. But what we find a lot of times is somebody will come in and say, hey, my score is 620. Well, if that's the online score that they're seeing, Kel, there's a good chance that we could be pulling under, let's say, a 600 credit score. I've seen it maybe pull 40 to 60 points lower when we actually get their score. So the key is we need to sit down, do a game plan, or someone like us, you need to sit down, actually get pre-qualified and start putting things in place. Know what your credit scores are now. Know what the plan is. Where do you need, if you need to improve them, what do you need to do, right? And then thirdly, kind of get an idea of what kind of money, funds for down payment, closing, things like that. We've talked about that in other shows. What are you going to need? So getting prepared literally 12 months out, starting this process, because as you said, Kel, in closing, I'm going to share this one more time, that 40-point difference in your credit, that literally could be somewhere between, depending upon your loan amount, anywhere from 2,000 or more per year difference just on a 40-point difference in your score. So that's why it's critical. That's the advice. 12 months out, start looking, get with somebody like us, and find out what where you're at and what you need to do.
You got it. So credit score is costing you. The question is how much? We will see you next time on the UM Show.